Well, let's welcome now on the show Sunil Jhaveri, of mentor, author, and an advisor and the founder of MrBond.in. Sunil, thank you so much for taking our time and joining us. Well, if you just heard the headlines that we read out right here on the channel, the Nifty is at a record high, the Sensex is at a record high, the mid-cap index is as well at a record high. What do you make of this pickup once again in the markets that we've seen? Does it leave more room for wealth creation as well for retail investors?
Thank you for this question, because this is plaguing the minds of many investors across the country and across the globe also right now. I'm not saying this, but RBI Governor has made an official statement saying that markets are in a bubble zone. How do these bubbles get created? Bubbles get created when there is too much of liquidity, easy money, chasing certain asset classes, which includes equity, cryptocurrency, etc. Housing market is also in a similar situation, at least in the US context. And when do these bubbles burst? That's when the liquidity starts drying up, is when this bubble, which gets created in different asset classes, burst, and then that's when the investors are taken aback. Now, what will happen and why will the interest rates start rising is a question which is there on everybody's mind, but we do not know the exact timing. So in the US context, if you understand, inflation is on the rise because of the extremely easy money situation there, fiscal stimulus, putting money into the bank accounts of the investors, etc. Now, going forward, if the inflation is supposed to be on the rise, then the Fed will have to have some kind of a reversal on the interest rate scenario, and their call on the not pausing the interest rate rise increase in the US context. If that happens, then the 10-year treasury, which we generally track, will start rising and go towards the 2% mark. And when emerging markets money will start moving out and then go into the US dollars, and that's when the dollar index also starts rising. So these are the data points which investors must be aware of, and they should keep a track of this: the US inflation, the US dollar index, and the US 10-year treasury yields, which will give us a surprise sometime in the near future. We do not know when, 3 months, 6 months, we really cannot time that so accurately.
Okay, all right, fair enough. Now, Sunil, if we look at, if we just rewind the clock a little bit and we look at 2019, 2020, obviously investors have been pretty disappointed, whether it's the large cap funds or, of course, more so for the mid and the small cap funds. None of them really have generated much return. However, I think you've shared a very interesting data point with us that a majority, a big chunk of the return has come in the last 1 year, as opposed to, from 2015 to now, 2016 to now, 2017 to now, etc. So in a way, I mean, should mutual fund investors as well bother themselves with timing the market and stuff?
Yes, so the question of timing the market is the question of, applying your common sense and logic in terms of certain valuation matrix. In 2017 July, we had given an exit call based on my own algo saying that markets are expensive, please exit. If you notice from the chart, and if you can just show that to the viewers also, from 2017 to 2018, the July 2017 to Jan 2018, the mid cap and small caps had a huge rally. So anybody who would have been outside these two segments would have been very disappointed for this short period of time. But from Jan 2018 onwards, mid caps and small caps started correcting profusely, which was not evident because people tracked Nifty 50 as a benchmark and not realizing that the mid caps and small caps were bleeding. So from July 2017 to December 2019, the mid cap and the small cap Sensex indices had delivered negative returns. Come March 2020, the Nifty 50, which is the large cap, mid cap and small caps, all delivered negative returns. So when people give me this in isolation, from March 2020 to now, small caps have delivered 135% return, mid caps have delivered 100% returns, and so on and so forth. How many of them have actually participated from March 2020 onwards? According to me, very, very few, because that was the time when most actually exited and not entered. As against that, so please understand. So if you don't take, a single point-to-point returns kind of analysis out of context and then say that we have missed out on the rally from March 2020 to now. But if you see from July 2017 to now, if you are in the same Nifty 50, I have shared the data with you. It has delivered 12.73% return. Nifty mid cap has delivered 9.86% return. Nifty small cap has delivered only 6% return. In spite of this humongous rally. And why did that happen? Because those who had invested 1 crore in July 2017, by March 2020, small cap index, the Nifty small cap, the value was only 43 lakh rupees. So we were only recouping the losses from March 2020 to now through this rally. So those who take the entire cycle in calculation, then you will realize that they have delivered no returns, as you rightly pointed out. As against that, our smart solutions, which we have been recommending, we exited out of equity in July 2017, entered back in March 2020, again exited out of equity in July 2020, and we are sitting in a conservative asset class like dynamic asset allocation funds. We have delivered more than 13% annualized returns, whether it's a Nifty 50 mid cap or a small cap. So please take, unfortunately, investors have very short memories. They forget the 2018 to 2020 scenario. And again, repeating the same mistake, I do not know whether we are in a similar situation. As RBI Governor saying, we are in a bubble zone. Only time will tell whether we are in a bubble zone or not. But yes, my logic says that if I'm in a conservative asset class currently, created a margin of safety in my portfolio with some cash in hand, nobody likes to have cash in hand during a bull market. But if that cash in hand helps you not book humongous loss during a bear market, it's worth that cash in hand is worth it. And I'm not being extra conservative by being a dynamic asset allocation fund from July 2020 to now. People can accuse me of being extra conservative if I was delivering 3% in a liquid fund versus the markets delivering 100%. The dynamic asset allocation funds, pro-cyclical, counter-cyclical, whichever ones you want to take, call off, it has delivered 50% absolute returns from then to now, as against 100%, with almost 60, 70 or 50% money still lying in cash. On a risk-reward basis, what would you prefer going forward at the current fundamentals, the overstretched market valuations? So, when investors start chasing returns, I tell them that please understand that is the time when your downfall in your wealth creation will start.
Sunil, I have so many follow-up questions actually. Firstly, what would you then advise those individuals who, like you mentioned, have been sitting through the entire cycle and, largely have seen minuscule returns? Because first there was that period of negative returns, and it's only in the last 1 year that largely it was just recouping of the lost returns. So what would you advise those mutual fund holders? Because, most mutual fund holders, prudent personal finance practice says that if you're investing in the equity MFs, you have to be long-term holders. So we would assume till now, most holders are prior to 2017, maybe 2016, 2017. If you are saying that right now, your algo is telling you that, maybe have a little more cash, be a little more conservative, what should these mutual fund holders do then?
Simple. Dynamic asset allocation funds is the ideal category for them to be in at the current level, or equity saving fund, which is 20 to 40% in equity and balance in debt. Dynamic asset allocation funds are 30 to 80% or 30 to 100% in equity, depending on the market valuations. So if the valuations are expensive currently, they may be 40% in equity and 60% in cash. So, these are the kind, and there is a counter-cyclical dynamic asset allocation funds who are increasing equity allocation through the momentum and trend analysis. They may be higher in equity and participating more in equity rally currently. So, you have a combination of a counter-cyclical and a pro-cyclical kind of dynamic asset allocation funds. That's where you should be, and you must have some cash in your hand. Because, even a 5% probability of markets correcting going forward, you have to protect downside of your portfolio. investors must realize that this money which they are talking about and which they have saved by letting go of a lot of dreams, aspirations, and goals, their first and primary objective should be to safeguard that principle. Returns can be a byproduct of which investment strategy you follow, but you should not be chasing returns. Unfortunately, we tend to forget all the teachings of Warren Buffett during bull market period, and we start remembering them in the bear market period. So those two famous quotes of Warren Buffett, one is rule number 1, do not lose money, and rule number 2, do not forget the rule number 1. And the second one is be greedy when others are fearful, and fearful when others are greedy. Should you be fearful now, or you should not be fearful now? Or should you be fearful after the markets have corrected?
Okay. So right now, if someone has large caps, mid caps, small cap mutual funds, and I suppose a majority chunk of them do have, would you recommend maybe a partial redemption over there and moving that money to dynamic asset allocation, and of course holding a little cash as well?
Yeah, but it's very difficult to generalize and tell you. But my system works binary. Either you are in an equity fund or you are in a dynamic asset allocation fund. So my system does not take you part by part into dynamic asset allocation fund. We are in expensive zone. My entire portfolio of me, the followers, my subscribers who are mutual fund distributors and their investors maybe would be in the dynamic asset allocation fund category at the current juncture.
Now, many of our investors put money based on their goals. Some of them say that, they're just investing for general wealth creation. Some say that, they've saved up money to buy a home. Some say that they've saved up money for their retirement or whatever it is. Should those investors as well be looking at it from, the lens that you created for us? That okay, now is okay, 3 years are done or 4 years are done, and now the market is at a record high, so you should consider taking some money off the table. Does time horizon as well play a picture here?
See, most important time, of course, time horizon plays a big picture. But most importantly, let's assume that your goal was supposed to be in March 2009. You wanted 10 lakh rupees. And we told the investors buy and hold or sip karo bhul jao. And the value of that same investment was 10 lakh in 2008 January, but it came crashing down to 6 lakh rupees or 5 lakh rupees. Now, nobody was telling them when to exit, right? Nobody had told them closer to your goals, you exit your portfolios. It does not work that way. You have to be in the right asset class at right valuation. And the most important aspect of your portfolio or your strategy should be downside protections. We are creating Abhimanyus. I have said that several number of times that we are creating Abhimanyus out of equity investors. Something similar may just happen going forward. 2017 to 2020, if you were in a dynamic asset allocation fund, you generated lesser return maybe than Nifty 50 during that period. But at least it protected your downside. It gave you an opportunity to participate in the upside by investing in equity at the lowest valuation possible when the rest of the industry was actually exiting. That is the power of having your own choice of investment at your own valuation metrics versus you are forced to sell something because you're panicking at that time when the markets are correcting. The statistics have revealed that 80% of the investors invest in the red zone and only 1% of the investors invest in the green zone, which was 2008-9 correction, 2010-12 correction, 2020 correction. Only 1% of the investors have invested at that time.
Refreshingly different perspective as well adopted to investing. Be in the right asset class at the right valuation. The general tendency is invest and forget, but that does not necessarily work all the time. For example, a great example is those investors who may have invested in 2009. it can be quite, it can require an enormous amount of patience really to see your money go through all those the tops and turns. But the right strategy, according to Sunil, is downside protection. We often chase returns so often that we forget that principal conservation should actually be of prime importance. Okay, well, if you have any questions or queries at this juncture, you can write in to us on the Money Show at etnow.tv. If you'd like to ask Sunil anything about the approach he adopts in investing and how it's so different from the usual approaches adopted, write in to us. Okay, let's take on board our very first question from Sunita Maheshwari. Sunita says that I am a 44-year-old doctor. I want to invest rupees 10 lakh in monthly interest instruments like NCDs as I utilize the annual investment of PPFs, and I also have 30 lakh rupees in direct trading in equities and some investments in sovereign gold bonds as well. So I'm not sure why exactly she wants to put in NCDs, and that too something that generates her a monthly interest. Perhaps she requires that monthly income. Do you think this is the right approach, Sunil? She already, by the way, has 30 lakh rupees invested in equities.
Yeah, so the first and foremost, I think she's only understanding that she will start getting monthly interest from that NCD investment. Where I beg to differ is NCD, if you're taking a single issuer exposure of 10 lakh rupees into your portfolio, and if that the borrower defaults on that NCD, your entire principal will be at stake. So that's really not the right way of investing. If you still want to invest in a debt instrument, then there will be better mutual fund strategies in the debt space also. But having said that, if this is a long-term money, which is, the 10 lakh, she's just 44 years of age, and let's assume this is a long-term money from which she wants to create some kind of a monthly regular cash flow. I am not sure whether she wants to do it from day one or at a later stage. I'm assuming that she wants to do it at a later stage. So what we call deferred annuity, the ideal product for her would be to invest in a balance advantage fund kind of a product. Let that money grow over a period of time, 5 years, 6 years, 7 years. Once you've inbuilt a cushion, then you create what we call systematic withdrawal plan. So SWP. So if you are withdrawing, say, 67,000 rupees per month, it is 8% on a 1 crore investment. So something on those lines is what she should be creating, something like deferred annuity. Let the money grow in a BAF kind of a product over a 5 or 6 years or even 10 years, or this can be her retirement kitty also at some point in time. And then start your SWP rather than getting into an NCD for your regular income.
Okay, so just a strategy recommended by Sunil. We just received one more question from Tushar Vai. Tushar says that looking at the market conditions, I want to invest in the multi-asset fund. He wants to know your opinion on the Motilal Oswal multi-asset fund and the SBI multi-asset funds, and if he should invest in lump sums. Now, I suppose the reason why he's looking at multi-asset funds is because he's lured by the massive rally seen in commodities. And these funds invest in commodities, though when you take the definition of commodities from the context of these funds, it more often than not includes more of gold rather than the other commodities, which have seen a much more massive rally. Is this a good time, according to you, Sunil, to invest in an asset class that splits its money across equity, debt and commodities?
It's a great, instrument concept. I like this concept because it invests in not only domestic equity, it invests in the global equity also. So there's an international equity, domestic equity, debt, and gold. So these are the four. And the fifth one right now, maybe going against us, is the dollar appreciation also. So these are the five asset classes which you are investing through a multi-asset fund. Should you be investing lump sum at one go? Global equities at an all-time high, in domestic equities at an all-time high. Debt interest rates are at an all-time low, so it can just reverse out some point in time in the near future. The ideal way of investing that would be to stagger it over a 1 year period.
All right. So basically, just like an SIP, staggering it over a 1-year period, it's always a good idea to invest if you have that option to invest that way in risky asset classes or volatile asset classes. All right. We have another question coming in from Somen Ghoshal. He says, I'm a 50-year-old school teacher. I'll get government pension on retirement at 60. Daughter is 14. I have the traditional investments like LIC and PPF, but I don't know anything about investing. So I assume obviously over here he's talking about investing in, equities or debt. He says, I can invest 20,000 rupees per month. So relatively a smaller amount, but at least his source of income is sorted post his retirement because he'll be getting his government pension. Plus he's got his PPF as well. So there is a little retirement kitty he's managed to build. But yeah, if a 50-year-old who's going to retire in 10 years has to kickstart his investment journey today, Sunil, where would you recommend he starts off?
At SIPs into equity, any of the equity funds. If he was 55 plus, then I would have recommended SIP in a dynamic asset allocation fund, because over a 5-year period also, SIPs have delivered negative returns. So you don't want to have a, jhatka at the time of retirement. So on a 10-year horizon, it's very safe to assume that you can start investing in SIP in equity schemes, preferably flexi cap and some flavors of international equity.
Okay. All right. And I think we have time for one more question. If we can take that as well. And I think it's a very relevant question to the topic and the circumstances right now. Santu Mondal says that if the market goes through a sustained rally, will the lump sum investor gain more than the one who staggers investments across several months? And also the SIP investor will lose if the market rises and then corrects. So should I stop my SIPs and sit on cash and wait? I know you mentioned, Sunil, that you should have a little cash with you, but stopping SIPs, right approach?
No, it's not the right approach. Of course, the SIP, what my exit strategy from SIP would have done is if let's assume you had invested 3,60,000 over 3 years and that has grown to 6 lakh, 7 lakhs, that amount, my system would have switched into a dynamic asset allocation fund, but we would have continued our SIP because there is no point in disturbing your SIP. But I would have continued the SIP in the red zone, which is the current market, into a dynamic asset allocation fund, in the yellow and the green zone into equity funds. So, but that's a complicated thing, which an individual investor will not be able to manage on his own. So he should continue his SIP, but as I said, downside protection is extremely important because your current portfolio of SIP is nothing but lump sum, and that should be protected from volatility.
Okay, well, I think with that we are out of time. So we'll have to just wrap up the show, wrap up this segment. Sunil, I really appreciate you joining us today and sharing with us what your investment strategy is right now, especially as the markets are at record highs. Some investors, who had the gumption to invest in March 2020, of course, are sitting on very, very healthy returns. Some, of course, not so much. But, this is how the markets are. You have your tops and turns. And that's the reason why Sunil suggests that instead of that buy and hold approach, you need to be in the right asset class at the right valuations. Thanks, Sunil, once again for that.